Let's open this up to a broad conversation. Joining us to talk about the markets and the economy is David Bianco. He's DWS Americas CIO. Our own Mike Santoli, senior markets commentator, and of course our guest host today, Larry Bossidy, who's former Honeywell CEO and a CNBC contributor. Mike, let me start with you. We are looking at the markets indicated up once again today, and I think right now the S&P is only about 1.6% off of its all-time high. Why this upside push constantly?
It's sort of this fascinating reassessment after we got through August, which is, yes, the S&P is relatively close to its all-time high, but a lot of its components are way below their highs. More than half the stocks there are down at least 10% from their high. That actually turns into a good thing if the market's getting more comfortable with the economic outlook and you say, look at all these beat-up cyclical stocks that seem like they were discounting a recession. Bond yields going up also is a kind of the financial markets relaxing a little bit about the imminence of some kind of a downturn. So all that stuff put together, I think it leaves you with a sense that stocks and bonds got very stretched in their relationship, and that's pulling back a little bit.
If there are some battered stocks in there, that means that there are some that are more than pulling their weight. Do you worry about those, or do you think those are fair valuations?
Certainly they're making the market appear more expensive or as expensive as it is. I don't know if I would worry about it. It's in a way kind of natural later bull market behavior where you do have these kind of consistent winners up there. Also, profit margins among smaller and mid-sized companies are much more vulnerable and they're not holding up as well. So I do think everyone's kind of hiding in where there's resilience.
David, that's almost counterintuitive, just because if the small guys are getting beat up, you would think it's really the multinationals that have more to risk right now because the market trades on these headline news out of trade talks with China every day.
The smaller cap companies tend to be the more vulnerable businesses, more dependent on ingredients to their manufacturing, so supply chain disruptions. Mike's right that there's been some interesting things under the surface of the equity market where defensives have gained a lot of made strong gains during the summer. Growth stocks continue to outperform, but the market's only 1.5% off its highs. I think very complacent given the risks. I think the earnings estimates for third quarter and fourth quarter are frankly unrealistic. They will be cut. And my view is that the S&P, I'm not going to just go so far as to say I'm bearish. I'm in a very corrective mood. I believe the S&P is likely to fall 10% or more in the coming months.
That doesn't sound very bullish.
Corrective.
Corrective is the way we put on it. Larry, go ahead.
What is the consequence of this? Do you see a recession, therefore, coming in 2020? Or do we muddle through the election and worry about 2021?
6 months ago, I would have said the chances of a correction are only about 15%, not any greater than usual. I've made the case that this expansion should be 10 to 15 years long. But right now, I think the chance of a recession in 2020 is more like 25, 30%. I'm of the view, and those odds reflect that my view, that all of these tariffs get phased in and are likely to be with us almost all of 2020.
Larry, does that sound like it fits into your assessment of things or not?
I don't think we'll have tariffs all through 2020. I'd like to think that they wouldn't anyway. It may be that's the case. I think the Republicans will do everything to conclude this trade thing before the election. Now, whether it takes two to do a deal and whether they in fact can accomplish that, I don't know. But I think there'll be a major effort, and in my mind, it'll happen.
I mean, the interesting thing is that when the market starts to get nervous about a rising probability of recession, as has happened recently, and you see bond yields go down so much, it looks a lot like whether you're actually going into a recession or if it's another scare. So a lot of this stuff, if you go back to the last time you saw yields this low, valuations in this area in terms of stocks versus bonds, it's 2016. It's not back to the last time you were entering into a recession. So the best buying opportunities of this bull market came at times that looked a lot like this, but at some point there's going to be a time that looks like this that ends up in a recession. So I do think that we're not I don't see an escape from this debate or from this, from this kind of cycle of worrying about it until you get something decisive. Market loves when trades set aside, and I think when you have a date for a meeting, it means it's not every single day, pins and needles in terms of trade headlines.